I think one of the most common questions anyone gets whenever they're starting out in the market is most likely going to be how much or what percentage of their money should they have invested in the stock market. So today I'm going to try to answer that question as best I can. Um, Going through a couple different factors we can look at in order to determine what you believe might be the best strategy or way to look at it. So I think today we will be discussing age is going to be an important one. Should we base it off of age? Does that have a good factor there? Income. How does income play into effect there? Don't mind me. Are we going to take maybe accounting to your own, your lifestyle? And how about why don't we say the final type we'll look at is your investment style? How does that play into an impact in terms of how much you should be, putting in the market? So first we will talk about age. So as far as age is concerned, one of the most common things that I've tend to hear is that age does certainly play a factor regarding this. Typically, the younger you are, the more you should have invested. So let's say if we're making this little chart here, very straight lines. I hope you're happy. So this is going to be your age on the x-axis, and this is going to be your percentage in the market. Pretty well, what you want to look for is something a little bit like this, to where as you age, that percentage in the market is going to decrease. And there are a couple reasons for this. So when you're young, it is best to set aside as much money as you can for your retirement in the end. So when you're older and you don't have a reliable, steady source of income or the ability to get a reliable, steady source of income, let's say you're retiring, the retirement age keeps increasing. Let's say you retire at age 70. You're not going to be having a job to bring you that income in. So what is better is, first off, obviously, depending on your investment style, you could just be able to live off of what you have in the market. If not, you might need to sell off some of that stock percentage to have that in terms of cash. And this is why things like 401k exist in a Roth IRA. These are things specifically saved for your retirement for you to use when you retire, which makes plenty of sense. So obviously you can have your own, unique brokerage accounts, whatever it might be. But yeah, so I would say age certainly does play a factor. I think you need a higher percentage in the market when you're younger as opposed to when you're older. That's my opinion on the matter. Invest as much as you can early to reap the benefits further down the line. And if you can keep that percentage somewhere even a little bit more sloped, obviously this one it's a little bit different. So if we can keep it somewhere a little flat, maybe a little bit down, that's ideally what we're looking for. Next, we're going to take a look at how income is going to affect. And income, I would say, I could pretty well tie it to this lifestyle here. It's they're pretty well dependent on each other. So income, obviously, just being the income that you make. This is going to be active income that I'm referring to here. What you make in a year in terms of salary. So that obviously has a big impact on what exactly you can even put in. If you're only making $30,000 a year, there's only a certain amount you can actually put in a year. Now, when considering that, you can also consider your lifestyle. So let's say you're bringing in $30,000 a year, but you're living without expenses. You don't have car payment, house payment. I don't know what world this exists in, but so we'll say you're making, let's say, $50,000 a year. No expenses. You're living a cheaper lifestyle, and you're okay with that. Well, guess what? you can definitely certainly invest more. You can definitely have a higher percentage of your market, your value in the market, in terms of your stock portfolios. You absolutely should have a higher percentage if you're okay with that. Now, obviously, that doesn't necessarily work for everyone. So some people are going to, as their, let's say as their income increases, sometimes, let's just say that their lifestyle increases, which is perfectly valid. Some people, it makes plenty of sense to spend, if you're working hard and you're trying to earn that raise, that promotion, it makes sense you'll want to spend that on yourself. From my perspective, I am more of a income increases, lifestyle stays flat kind of guy. That's my perspective on the matter. I think you should live beneath your class, I should say. I don't necessarily know how I want to word that properly. In my opinion, you live below your income level. That's my opinion on the matter. If you're rich, you don't need to live rich. You don't need to live in a mansion. You don't need to live. You don't need to get 3 cars. That's my perspective on the matter. I have no issue, and I know if 100% if it were the case, if I got to the point where I was a millionaire, I'm not going to change my lifestyle. I'm still going to live a pretty basic lifestyle. Nothing necessarily over the board, too crazy to where I'm actually, spending more money than I want to. I want to then use that money to go ahead and invest more. So that percentage may stay the same. Again, the percentage of what I'm investing may stay the same in the amount, but if I have a higher income, that percentage technically means more. But if I'm increasing my lifestyle, that percentage is likely going down because I'm going to be spending more on my lifestyle, and that income there is going to be less of a factor if I keep spending more on that lifestyle. So, again, it depends on how you want to necessarily live in terms of that aspect. Naturally, with rising income, I believe you should keep that percentage either stagnant or increase. It entirely depends. Just don't let that lifestyle increase potentially change the percentage you're bringing in. Don't cut down the percentage of money you have stowed away, so that way you can pay for a 4,000 square foot mansion or an in-ground pool in the back. Okay, I understand that sometimes those things are frivolous, they're enjoyable. You don't need them. I would say live needs based. Definitely don't try to splurge too much. I think on occasion there's no issue with that at all. But in my opinion, you definitely just live below your wealth, and that way you can actually reap the benefits when you're older. And finally, I think I want to talk about investment style. So it's definitely a factor here. So there's really, in my perspective, a couple different investment styles to talk about. So we have, let's just go with a nice, safe dividend investor. They're investing, their portfolio's getting somewhere around, let's say 3% in terms of yield. They're just collecting dividends. That's what they want. You have let's just say, I'll call it an index investor. So they're pretty much just going to be investing in an electronically traded fund that will mimic the performance of the S&P 500 or the Dow Jones or the NASDAQ. That's all they want to do. That's all they're going to do with their money in the market, is just invest in something that will mimic the performance of the market. We also have, let's bring them up. We have the options investors, okay? Or I'm going to say either options / penny stock / high risk, okay? Got to throw these in as an example here. So definitely consider these guys. And I probably would last year just throw in let's just go with someone he's looking at growth stocks. Obviously, there's plenty of different types of investment. You can really do however you want. You can do a mishmash, whatever you plan on doing. So my perspective in terms of this on a dividend perspective, if you're a dividend investor, I personally believe, like I mentioned in that first example of age, you're going to want, if we're looking at this this chart here of percentage versus age, I'm going to want that percentage to pretty well stay flat, okay? Which would make sense. So you're going to keep earning that dividend, and that dividend is going to keep compounding on itself, and you're going to keep making more in terms of dividends. That's the point of the dividend portfolio. You want to make yourself a passive income that you can live off of and be plenty fine and not have to really sell around or purchase that much in terms of extra stock. That's really what you want to set yourself up for. The basic index investor, again, there's not necessarily, you might get a yield somewhere around 2% in terms of this. So this is more of a moderate one. We're going to use the same, y-axis percentage, and this being age. I would say you want to keep this one a pretty flat slope. I think it should decrease as you get older, as you use that money a little bit more in terms of preparing yourself for the future. If you're just a basic index investor, it's good to have that money in the market, but I think over time, percentage certainly can decrease as you get closer to retirement. There's no issue with having that. So let's say for these options traders, and let's be fair here. So let's call this. I'm gonna say this is the 70%. So these are all gonna be based off 70%, just so you know. 70% I'll say is the base with a starting age. Probably 20 to 25 is what I would consider here. So I should have mentioned that before, but let's do 20 to 25, and that's pretty easy to see. I promise you can see that. Don't worry, it's perfect handwriting. I wish I had an actual pen instead of writing on a mouse. It's tough, okay, guys? So these options traders, these high-risk traders, they have a big chance that they could lose a lot of their money in the investments that they're making. So my perspective on the matter is, well, if they're having issues with it, you know what we're going to do? I don't think you should have that high of a percentage. So if you're doing this high-risk investing, I think max, you're going to be doing 5 to 10% of your wealth. And that's entirely it. And that's, again, I still think this should be a pretty fast declining slope. If you're doing just investing in these high risk things, I would say that cutoff age should be somewhere around 40 even. Once you get into your 40s, you should not really be messing around with this type of investing. And I understand the people that do it, they want to seek some quick gains, and it makes plenty of sense. It's just very high risk, and when you get older, that money is going to be a lot more valuable to you, and you can't really afford to lose it. It becomes a lot more difficult, to make up that money. If you lose all your money investing when you're 60, you've made a mistake, and how are you going to earn that back and actually be able to retire? And there's so many factors to consider here. So I would say max 5 to 10%. Get done out of those high risks by age 40 at least. And this is if you're doing just a high-risk portfolio, obviously. So 5 to 10% of your wealth max. You don't want to really put yourself at a risk to lose all your wealth. Even when you're young, you still don't want to take a risk like that. I know a lot of people consider it because they're young. They can, quote-unquote, start over. I just wouldn't consider it that great. And then finally, we have our lovely growth investing. So this one, it's a pretty basic one. I would consider this being a little bit different. So growth, obviously, we're looking for portfolio value here. So again, this base of 80%, just kidding. I meant 70%. So this base of 70% here, based off this percentage and age again on the bottom. I would say starting at age 18, so you're going to be at this 70 line for quite a while. And again, I'm probably going to give this cutoff around 40. This is really the time. You know what? Let me go ahead. Forget I did this 70. I'm going to drop her down. Let's go 50% of your wealth. There's a lot more risk in these growth stocks than there would be in a dividend or the index funds. So we're going to say 50% of your wealth, in my perspective. And then once you hit age 40, that's when I want to see it decline a little bit. And then eventually you should be able to taper off that. So that's not necessarily the flat line you might have seen before. We're going to do a little bit of a mixture of both. I want to keep that percentage flat. And then once you hit age 40, when it's time where you can't really take as much risk, that's when you start decreasing the value in terms of that, and maybe that's when you shift over to a different investing style. And again, these aren't necessarily dollar amounts here. If you're looking for dollar amounts, it is entirely based off of things like income. So obviously these are percentages. This 70%, this 50%, this 5 to 10%. Down at the bottom here on options, it's entirely based off what you're bringing in. So that should be a percentage of your total wealth, in my opinion. This is a percentage of your total wealth is what I'm referring to, and it all differs depending on what that wealth is. So this is my perspective on how investing should go. I think obviously, and it makes plenty of sense. You're a lot more risk tolerant when you're younger than you are when you're older, when you can't really afford to take that risk and lose money. I personally am a very safe investor myself. I'm more of the dividend route than most probably, at least for my age considering. But I certainly have a plenty decent share of growth in my portfolio as well. So there's considerations there. This is my perspective on what percentage of your money you should invest. So I hope you enjoyed.